Okay, hello everybody, and welcome to Investing with IBD for September 4th, 2019. I'm your host, Irusha Pierce, and with me today, once again, is Justin Nielsen, Director of Research at IBD. Thanks for being here, Justin.
Thank you for having me. This is going to be a good one.
Now, on today's podcast, we are going to talk about the current markets. And then in segment 2, we're going to get a little bit more fun and a little bit more related to what's going on this week. This is football week, and we are going to talk about football and fantasy football, and then we will end the episode on current stocks.
Yeah, and just to be clear, it's how fantasy football relates to stocks, not just, oh, we just drafted and here's our team.
Oh, now you're telling me.
Right.
Yes. So Justin, it is football season now, or the NFL's about to start tomorrow. College football started this last weekend, and so we both love football, and so what we want to do is go with this theme and really talk about how there are a number of parallels between football and the way we invest.
Sure. And just in case people want to know a little bit about the prop that we have here, we're both in a fantasy football league, and this was the trophy from that league. We actually borrowed it from our colleague, Jack Pacheco. He was actually the winner of the season, and this is one that kind of went through the ringer in terms of shipping. So if you're wondering why the tape is there and the holes and stuff, that's
it's a tough football trophy.
Yes, exactly.
That's what
it's
it is.
Weathered. Builds character.
So let's talk about the character of the market, the overall markets right now. We're under pressure, right? And we've been under pressure for the last couple of weeks now. We had a follow through day and immediately was met with distribution. So we currently have 5 distribution days on the NASDAQ, 4 distribution days on the S&P 500, and it's been a choppy market. The NASDAQ's under the 50-day, and it's been kind of hanging around under the 50-day for the last, 4 weeks now.
Yeah, what's impressive to me is that with all of the headlines that have been out there between trade and recession fears, inverted yield curves, all of these things, I'm actually pretty impressed with how resilient the market has been.
True.
It's I would have really expected with all these headlines, if it were a weaker market, it would have easily undercut that 76.62 area that it made it low at the beginning of August. And that's held. So this rally is still technically intact because we had the follow through day and we haven't undercut that low. So that's the good part. The bad part is that 50-day moving average line is acting like a very stingy defensive line that is not allowing any yards past the line of scrimmage. And each time the NASDAQ gets up to that line, it gets knocked right back down and just can't make any progress. And so we've seen 1, 2, 3, 4, almost 4 times here. Each time it gets there, it gets knocked right back. And it's going to be very hard for me to get much conviction in the market until we are able to cross that resistance level. At least the 8,000 level is kind of an early level of resistance that it just hasn't been able to kind of maintain itself above that level for more than a couple days at this point. But even before that, a couple weeks before.
Yeah, and it's pretty amazing at how one day you'll have it the market's down big, next a couple days later it's up big, and you're like, oh, maybe we're out of it. But nothing in the end, nothing's been resolved. It's still the uncertainty. Will it truly maybe it only gets resolved when you get more of these larger macro events that are happening, they're actually resolved.
And there's some scary stuff. I mean,
there is.
Between Brexit and trade war, and a lot of times the market's been rallying on just like optimism. It's like, oh, maybe they'll talk, and then it's like, oh, no, they won't, or whatever. So, there hasn't really, even the big moves up really haven't been on much news at all. It's just been like, oh, maybe things are going to go in the right direction. So again, I think that speaks to the resilience of the market.
Yep.
I think it wants to go up, and I think we're seeing that with a lot of stocks that really are setting up and want to go up. But right now, it just keeps on running into, again, a very, very heavy defensive line.
which and speaking of defense, you in this type of environment, you want to lean more towards playing defense.
Absolutely.
Right. You don't want to be very, very aggressive here. You definitely don't want to be on margin in this because your portfolio is going to be whipping around. And it's really these kind of markets that are the most dangerous markets, right? It's not necessarily the downtrending market. We know what to do in the downtrend, just stay out of it. It's these indecisive markets where nothing's necessarily conclusive just yet, and there's still a chance, and there are leading stocks that are still hanging there. So it keeps tempting you in. So you want to have some exposure, in my opinion, but you don't want to be really pushing it,
right?
Because this is not where the easy money is made.
Yeah, and the easy money, if you just look, it wasn't that long ago, January 4th, when everything kind of turned, that's where the easy money was. And you saw it, the indexes went up, in a big way that first quarter, 20%. Our indexes were doing well, IBD 50 doing well. It was just, everything was moving. It's a trend following system, and right now there is no trend. And to that end, you don't want to be shorting either, because there's not a downtrend established. So when you've got this sideways action and trendless, you just have to be kind of waiting, biding your time, and keeping your watch list fresh.
Yeah, that is absolutely a huge point, because as Justin mentioned, there are a number of stocks that are hanging in there. They're showing tremendous relative strength. And when this is resolved, or when we get into the next uptrend, a lot of times those stocks that show the best relative strength, they're the first to new highs, and they're the new leaders of the next rally. So let's go a little bit further into just football and fantasy football here, because there are a number of interesting parallels that I mentioned before. But you, Justin, you brought up a good point. One thing that Bill O'Neill, the founder of IBD, has always said is, in every bull market, there are a number of leisure stocks that do well. And so that's a huge reason why you want to be paying attention to some of these trends that are just going on in front of you.
Right, exactly. And that's, I think, something that a lot of people can more easily grasp. If you go back to like the Peter Lynch idea of kind of knowing what you're investing in, and again, Warren Buffett doesn't make things too complicated either. Leisure is something that's usually pretty easy to understand. Oh, I watch Netflix. Okay, that makes sense to me. Or Priceline, that was a big mover, a number of years ago. Hey, cheap airfare. Hey, that makes sense to me. Getting cheap hotels. So there's a lot that's easy to understand, and kind of understand like when something is moving, and it's you can see the sales growth. You can see all of those things kind of come together, and it's not something where you're like, okay, how does IT use this? I'm not technical and I don't understand, the technology, or even like with biotech sometimes, oh, I don't understand exactly how this furthers the field in biotechnology. Leisure's usually a lot more easy to understand, along with retail.
Yeah, and one really kind of large leisure kind of event that's happened, it's really become a phenomenon over the last 15 years, is fantasy football.
Yeah.
Right. I remember probably 20 years ago, some of my roommates in college, they were into it, but no one else was into it. These days, everyone's into it.
Well, and it's, I think, become a lot easier, because now you can get streaming, real-time points, everything can just be everything's easier with the technology.
Yep.
How would you have done this like 30 years ago?
Yeah, like pen and paper.
Right,
That's
exactly.
Who wants to do that?
And just to kind of bring this back to leisure, there was a big difference in the 50s or 60s, when bowling was becoming really popular. And one of the things that kind of revolutionized bowling was when you had the pin setters that could automatically, you didn't have to have the kids, doing it anymore. And you started getting the automatic scoring. It just made the game a little bit more fun. And so Brunswick was one of the stocks that Bill, mentions early on in the 60s. And what was the other one? Begins with an A.
I want to say AMT, but it is.
Yeah, it was like American something pin setting or something, but they were the pin setters. So those types of things, it's again very similar.
So you've had technology really enable this fantasy football to get much more interesting, and I think there's a lot to learn about this, especially with stocks. It becomes easier for mainstream people to start using it. So all of a sudden, more and more people are into it. Now that spawns off more industries, right, or more businesses. Now all of a sudden, you have all these fantasy football experts out there. So just
podcasts, what have you? Yeah,
exactly. And so Justin and I, we share a fantasy football team in the league that we're in. And so this past weekend, what did I do? I went on YouTube and I was watching some fantasy football videos, trying to get up to speed on, who are the players who are good and all this kind of stuff. And it's just amazing at how many services are out there now for this. And so it's just this whole industry's grown. First, it was Yahoo had They were kind of the leaders. Now then ESPN got into it, then NFL. And so it is a kind of if you're trying to understand how businesses really grow or how an industry can grow, take a look at this one. If this is if football is something that you can relate to, or if you're playing fantasy football, just think about how many different companies have got into this world right now, because it's just become a multi-billion-dollar industry at this point, which was unimaginable years ago.
Right. Mm-hmm.
So the market continues to be volatile, and it's best not to push it at this time. Remain cautious. And remember to keep an eye out on trends in the leisure category. It's amazing at how you can stumble on some good stock ideas by just keeping your eyes open. So let's take a quick break, but when we return, we're going to talk about how football and the way you invest have more in common than you think. Stay tuned. Hey guys, if you really enjoy listening to the podcast every week, we'd love it if you could rate and review the show on iTunes. Your review and ratings really help out the show, and we would love to get your feedback. Thanks so much for listening. Justin Nielsen's our guest on Investing with IBD. Okay, Justin, so as I mentioned before, on Thursday, September 5th, the NFL is starting again. And so let's take this talk a little bit further and go in a little bit more parallels on how football and investing, or really the way we invest, there are really a number of parallels. Now, the first thing really is just the overall market. Now, where we're seeing the market right now, it's under pressure, it's indecisive. Mm-hmm. Where you can really make money in the stock market, as we know, is when you are in a nice confirmed uptrend. Mm-hmm. And the way I equate it is just it's when the football season's there. That's right. The only when the football season's open, when you're there from September to January, that's the only time when teams can actually score points.
Mm-hmm. Or you might even think of it as, you've got Thursday night football, you've got Sunday, and you've got Monday. Everything else, that's when you're doing your research and, you're getting ready, you're preparing. You don't want to be doing your research and setting your lineup on game day. You want to kind of do that stuff ahead of time. Now, you might have to make some adjustments on game day and, right before kickoff, but you should have your plan already in place, and it kind of goes back to the thing that we often talk about: plan your trade your plan.
And that's another perfect kind of lesson that really I learned over the weekend. We had our fantasy football draft this past weekend. Mm-hmm. And as we've learned over the years, it's very, very important to prepare for this, mm-hmm. for these drafts, because also the few players that they're going to be gone. Mm-hmm. We saw one person in our league. He was not prepared at all, right. And he completely panicked. He started reaching for players, mm-hmm. and he let his emotion start to kind of lead him. It's like, I know this one player that did well 5 years ago. Yeah. I'm just going to draft him, even though he
was going for, I recognize this name, but he didn't have any stats behind it.
Exactly. Mm-hmm. And likewise, the same way, when you're investing, you really want to have those. You want to be as objective as possible. You want to be able to use those ratings, use those stats, mm-hmm. And really let the market tell you what to do. If the stocks are setting up at this point, you're buying at a certain time. You're not buying because you like the company, or you just can't take it anymore. You can't let those emotions are getting to you. I'm just going to buy this stock. Right? You're being patient, and it was really, really interesting to see those same kind of emotions in the stock market and fantasy football during the draft this past weekend.
And you see that happen sometimes in terms of that emotional component. Sometimes people will just pick the players of the team that they like.
Yes.
And it's like, okay, no, you've got all of these choices. You have to look at objectively who's the best out there. And I don't care if you hate the team. It does kind of make it interesting sometimes if you're like, oh, shoot, I'm actually rooting against my favorite team because I want my fantasy football player to do okay.
Right.
And then the other point, just having to do with, especially for our particular draft day, is you have to be aware of your emotions and your state of mind. Hey, how much sleep did you get? If you're not getting enough sleep, you might not be making the best decisions. Now, I don't expect most people to do this, but we had alcohol available at our draft. You and I, we kept it together. I mean, we kept our alcohol content, our intake low, and I think that made us better at dealing with the contingencies that we had to deal with. Namely, that contingency plan that we had where we both had our computers, mine crashed. over and over again.
Yes.
But we were able to go to yours. So we had that contingency plan. So again, another thing that really helps with investing. If things don't go according to plan, how can you kind of backtrack and make sure that you're still acting appropriately?
Yeah, it's always scenario analysis. The reason why because I was going to depend on you handling all the
That's
computer
usually
work.
my thing.
Justin is the Excel master. And so I was like, okay, Justin, you take care of this, and I'll look at the players and all this kind of stuff. But I was like, let me just bring my computer just in case. Right? Same thing in stocks. You have to have an exit strategy. You have to know what are you going to do if the stock gaps down on you, right? You don't want to be going through that thinking process when you're emotional. You want to kind of put that all down ahead of time and know. And so that's what I did before we started. I was like, okay, if Justin's computer breaks, we have my computer. My computer breaks, we have paper, right? So we went through all that kind of stuff, and then kind of the unthinkable happened for us.
Yeah. And the guy the guy that didn't show up with any paper was trying to grab your paper.
Yeah.
And granted, that was our plan D.
Yeah, exactly.
And apparently, it wasn't even his plan A. He didn't even get that far.
Right. Now another parallel that we see is that. And this is kind of common sense, right? In football or any sport, usually the best teams will have the most, will have more of the better players, right? That they have the star players on their team. It's the same thing with the stock market or the way we look at growth investing. You're looking at the best industry groups first, right? So you want to be in the best industry groups, and then within those industry groups, you're going to have a number of great stocks, and ideally you want to be in some of the best stocks in that industry group. But if you're in a larger kind of secular trend that's going on within the semiconductor group or the software group like we're seeing this year, you just want to make sure you have some exposure to that group because there's a really large trend and it's carrying all of those stocks.
Right. And that's something that happens in football when these trades happen. And so now you've got Antonio Brown no longer on the Steelers. Okay, what does that do for the QB on that team? What does it do for him as a receiver having another QB throwing to him? So there are these things that can maybe change how you are looking at these different stocks. Because again, in that case, it's changed an industry group, and that doesn't happen very often. But one thing that it always sticks out in my mind is Charles Schwab. In 1998, when Charles Schwab was acting like an online stock. Because all the brokers were doing it was not acting like a brokerage stock. All the brokers were doing one thing. It was doing the same thing and making the same pattern that AOL was, because Charles Schwab had gone online with their brokerage. They were very early adopters in that, and they just were acting like something completely different from their industry group. And so you just have to kind of be aware of okay, when something is it a lone wolf in its industry group, or is it really part of something else? Those are things that you just have to kind of keep in mind.
Yeah, and you're talking about catalysts with Antonio Brown, who was one of the best receivers in football, being traded from one team to another team. Those lead to catalysts, and so recognizing those trends, those kind of larger trends within industry groups and within stocks, that's going to make a huge difference between helping you catch that rotation.
Right.
And that's one thing that I've noticed over the years, even when we're just playing fantasy football. There are rotations. It's fascinating. And the same way that that I see mistakes in investing, where if you're not quick enough to adjust, you're going to start suffering. In stocks, usually I'm pretty quick to get out. A lot of times in fantasy football, I'm like, I kind of get a little lazy and don't pay attention as much. And all of a sudden, all the others who are really paying attention to all the news and stuff, they're really adapting to those trends. They're adjusting. They're grabbing those players that are now going to benefit from this new trend that kind of happened mid-season.
And I think that's one place in which money can really make you focus. Of course, with our fantasy football, there's not much money on the line, and so that's not a big deal for us. But in our trading accounts, yeah, you know what? That money can really make you focus. And this is sometimes where people who are doing paper trading can actually miss out on something, because they're able to apply the rules and everything like that, but they're not getting a true sense of the way the emotional impact can be when you do have money on the line, real money. And paper trading is good. I think that that's useful for a lot of people, but you also have to be careful if you are kind of in that false setting without the money on the line and without that emotional component. You might find a different story when you start doing real trading.
Right. And now concentration's another another concept that we always talk about in investing. We concentrate more than most normal kind of systems out there, or kind of the traditional mainstream investing that you hear about.
Yeah, just as a point,
for it.
you know, I mean, like most people would never think to only own 10 stocks,
Right.
and we're very comfortable doing that.
Yes. So you concentrate in that way, but also we'll concentrate. We might have a little bit more concentration in one particular industry group.
Sure.
Now, the one thing you have to be very careful of, though, is don't have too much concentration in industry group. No more than 20%, 25% in one industry group, because all of a sudden, if you have a major catalyst, like say you have 25% in a semiconductor group, and Intel comes out during an earnings report and say, you know what, the whole industry is terrible. That's going to destroy all of your stocks. So if you had, say, 40% of your portfolio in semiconductor stocks, you're just going to take a beating at that point.
I mean, look what happened with the chips. You know, the whole China trade war.
Yes.
How does that affect the chips? You know, when if Apple's products are going to be getting tariffs slapped on them and all of these things, how does that trickle down to the suppliers and everything like that? Same exact thing.
So
now, some of that will depend on your comfort level. You know, as you get more, I guess, experienced and advanced, you might be able to up your concentration because you kind of know your discipline and know how quickly you can move. But so like for me, sometimes I'll have 20% in a single stock. So I can up my industry exposure sometimes, but then you just have to be aware that you do have that extra exposure, and you have to be a little bit quicker if you're recognizing that there is a turn in the industry and not getting like hung up on, oh, but I've made so much money. I mean, computer software, that was a big mover, this year, and you have to recognize when those things are turning.
And so likewise in football, if you're you don't want to concentrate all on just one team, right?
Yeah.
You don't want to take all the players from the New England Patriots, because if Tom Brady went down or something for a while, all of a sudden all those players are going to be affected.
Yeah.
So same way, make sure about the concentration. Now IPOs. Now IPOs, as we've spoken about IPOs a number of times on during the podcast over a number of episodes. And they're obviously more risky. They're more volatile.
Right.
And in many ways, they're kind of like the rookie players who are coming into football, where you haven't necessarily seen how they handle the NFL.
Right.
But you know that, okay, they were pretty good in college, but we don't have enough information just yet on them. So you have to kind of sometimes take a little bit of a chance on them, but you don't want to invest too much in IPOs.
And a lot of times with IPOs, our general rule is we don't trade on the first day. We're always wanting to see some trading history. In the same way, you'd probably want to see some trading history on a rookie, in football. You'd want to see, granted you have his college career, and that's almost like, oh, you have the fundamentals and everything like that. You still have the sales and earnings for the company before they came public. They provide that as part of the due diligence process. But there is, how are they actually going to trade? What does the market actually value them at? And until you get some of that trading history where you can actually see it, it's really hard to make too big of a bet there.
Balancing risk and reward. Now, looking for stocks that sometimes a great stock might come, or what you think is a great stock might come down, give you an opportunity to get into, or it's building a base. But it might have one too many flaws in it. Maybe its earnings per share rating is a little low, or maybe the base is a little too faulty. So a lot of times you're going to pay for that. When and Bill O'Neill has said this many times. If the stock doesn't work, there's a flaw you missed there. In your analysis process. Same way within football and stuff like that. We had during our fantasy football draft, one of the great players, Todd Gurley, fell to us in the second round, but we passed on him because there was just there's not enough information on whether his knee is healthy or not. So we're like, okay, let's take something else that has a little bit less flaws. We'll go with someone who's a little bit, quote unquote, safer, because we have more information on it. So you're kind of balancing that risk reward both in stocks, in football, the same kind of way. You want to make sure you have enough information there for you to make a decision you can really you can sleep on.
Yeah, and in the same way, injuries are something that absolutely affect football a lot, especially your running backs, which is why that's such a prized position in fantasy football. But you have to kind of be able to recognize that in your stocks as well. When your stock gets injured, when the base has flaws, you have to be able to recognize that and say, okay, you know what? It's maybe time for me to part company with it. And it could be your favorite player in the world or favorite stock. You've made so much money on it. But when you start seeing it get injured, and for us, that might be a break of the 10-week line on huge volume, something like that. Okay, that's an injury. That's like a tear, or that's something that's going to take some time to recover from.
Yeah.
And then you have the things where it's, a little bit more serious, and, that you might just have to completely get out. So there are the times where, it's not always an all or nothing where, we have the benefit of putting something on our bench. You also, with your stocks, have the opportunity to maybe just trim a little bit. You don't have to sell everything.
Right.
And then if it works out, hey, you can build it back up as it bases or breaks out again. But then some stocks, hey, you just want to toss it and get something new.
Yep, and a lot of times, the analogy that we use for investing is when they get hit hard, you ask yourself the question: is it a sprain or is it a broken leg?
Yeah,
right. Because that gives you an idea of how long the stock could take before it's back into new highs, right? How much longer do I have to type my money in the stock? And if it's broken, maybe you take your money out, go to a new stock. Okay, and then one more concept here that we're going to talk about. A few stocks make most of the gains.
Yeah.
So now we'll talk about first our fantasy football experience from last year. We drafted really well. We ended up with Patrick Mahomes, who turned out to be the best player in football.
And I can't remember what round we got.
We got him like the 11th round.
Yeah, it
right.
Was,
Yeah. So we ended up with a couple really, really good players. And in the end, it was those few players who really carried us. And we ended up doing really well in the season just because of those few players. Likewise, the same way with the way we invest in stocks, it's always a few stocks. If you manage them well, they're the ones that are going to make the difference. Everything else will just kind of even out with the small losses and cutting losses really quickly. And then sometimes, those small gains because they're not working out.
And just to share a study that I've done, on the IBD 50, going back to 2003, April 2003 for the IBD 50, it's about 10% of the stocks, maybe 10 or 11% of the stocks that you can basically point to. Almost all of the outperformance for the S&P against the S&P 500 are attributable to 10% or sometimes less. In terms of like in 2009, it was like Priceline, it was CMG, it was there's just Baidu. Yeah, exactly. They just they stayed on the list. They got on early. They stayed on, and that is what really drove the big gains for those indexes. A lot of our indexes, and just for the record. Last year, we had Mahomes, of course. Our other big player was Connor, who we actually picked up off the waiver wire because our number one draft pick that we had was Le'Veon Bell,
who decided not to play the whole year.
And, so here was a stock that we had to just basically cut and say, okay, what are we going to replace it with? And we just so happened to do a trade where we replaced him with some pretty good players.
Someone else who could take the business, right? If the one company went out of business, here's another company came in and took that market share away. Same thing. We just found the player who was going to benefit off of that. So understanding how to narrow down your choices to the best stocks or the best players, it's going to help you score points in whatever game you're playing. Coming up next, we will discuss a number of stocks that are benefiting from the football season, and they could be setting up on the chart patterns too. We'll be back. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. We are back with Justin Nielsen. So, Justin, let's talk about some current stocks that are benefiting from the big business of football.
Yeah.
Now, the first one on our list is Microsoft, and this is a really cool one because Microsoft made a deal with the NFL a few years ago, and now
back in like 2013 or something like that.
Was it that long ago?
Yeah, it was. I was reading about this because I was trying to like remember the chronology, and sometimes it's really easy to kind of, it all blends together. Like, how long ago was that?
Apparently, it
yeah.
does, yeah.
I mean, the iPhone just, that came out in 2007.
Yeah.
I feel like, didn't we always have iPhones? The iPad, came out a few years after that. Yeah, exactly. And so
the
Surface,
around there,
the Surface was kind of the Microsoft Surface was kind of their answer to it, and that NFL deal really kind of got a lot of publicity for, because you look at the sidelines and they're carrying Surface, Microsoft Surface tablets all the time.
Yeah, and all the coaches are carrying it, and it says Surface on it.
Right.
When you look at all the just the commentators, they all have the Surface tablets. It says, and also it wasn't just with the Surface tablets. Microsoft made a deal with the NFL on the Xbox, and their exclusive kind of footage that you can get for the NFL through that. And so this was really one of those things that Microsoft's tried to do to start to appeal to a larger audience, at least, or to the NFL audience, where they said, hey, you can buy the Xbox, you can get all this exclusive stuff, help manage your fantasy football team better because we're getting all these stats on it. So it was a way to try to appeal to this very, very specific audience here. Now, on the chart, this was, you mentioned 2013. Now, 2013 was around the time where they had a change in CEO.
Yeah.
Right? And that's when the whole culture kind of changed there too, right? They were more software culture at that point. They kind of expanded, right? They started coming out with the Surface, the hardware, and really branching into more kind of consumer devices too, to start competing with Apple. And really over that time, during that time, they've outperformed Apple.
Yeah, it's really incredible because if you look at a long-term Microsoft chart, of course they had the phenomenal run in the 90s, and then they topped in 2000 along with most tech, and it was really about 13 years, that right around 2013 is where they finally kind of got back to their old highs that they made in 2000, and that was really when things really started turning around for Microsoft. And as you mentioned, they've been a big outperformer since.
Yeah, and so much like when you can get a new coach that comes in can change the whole football team around, same thing here. They got a new CEO who changed the whole amazingly changed the whole culture around, because Microsoft is such a large company.
Yeah.
But he's pulled it off. It's been pretty remarkable. And Microsoft's been in this great uptrend for a while. And it's forming a flat base right now, and when you look at the Microsoft chart, Microsoft's saying we're going through an uptrend under pressure. What uptrend? What under pressure?
Yeah. So Microsoft is only 2% off of its high right now. It's 52-week high. It's barely corrected at all. It's maintaining itself pretty much above the 50-day moving average. So whereas the market is having trouble getting back above its 50-day moving average, Microsoft is pretty much remaining above it. It'll test it, it'll go down a little bit, but then it comes right back. So it's really, again, showing a lot of resilience, and you see that with the relative strength rating. That relative strength rating is very high, and the relative strength line has been pretty high lately as well.
Yep. And so the pivot point for Microsoft with this flat base is 141.68. So it's definitely one to keep an eye on. I do own shares of this stock.
And so you'd add 10 cents to that.
And you would add 10 cents to that. So 141.78 would be the buy point. And the reason why I've kind of favored Microsoft over all the other larger tech stocks is on the chart. It hasn't really corrected that much versus all these other large cap tech stocks. They've been building these huge bases. They haven't really participated in this uptrend during 2019.
Yeah, and just to kind of bring it back down to the ratings, and this is again, one of the things we look at with fantasy football. We're always looking at the stats and everything like that. The composite rating for Microsoft is 97.
Yeah.
So this is, I like to kind of look at the ones that are 95 and higher. That's where the leaders tend to be, and this is obviously one of the leaders. Now, we always make the kind of caveat that it's not just the brand name recognition that makes a leader. It's the earnings growth and the sales growth.
Yep.
Microsoft just happens to have both. They are an earnings leader, they are a relative strength leader, and they have huge brand recognition.
Perfect. Now let's go into the second stock here, and really the next 2 or maybe 3 stocks that we go over, they are all alcohol related. The first one is Diageo, ticker symbol DEO. And now these guys have quite a number of brands here. Guinness, Johnny Walker, Crown Royal, Bailey's, Smirnoff,
Captain Morgan,
and Don Julio.
Yeah. Okay. Oh, I didn't know that one.
Yes, Don Julio, which that was one of the things that we tasted this weekend.
Right. Exactly. And again, Arusha, you showed such restraint. It was very good.
But this is one out of the beverages. These guys have just recently built a cup. It recently, let's see here. Let me go the daily chart.
So of course
it just
you have your
broke out
beer
today.
You have your beer,
or maybe your high grade tequila like Don Julio.
Well, I was going to say, if you're not doing the carbs, if you're kind of trying to stay away from that, if you got the keto plan going and you need to stay away from the high carb beers and stuff like that, then you can switch to DEO for your choices.
And so they formed a cup. They just broke out today out of this cup. Past the 176.07 pivot. So they didn't really, I guess, he actually did. It got the buy point would be 176.17. So it reached a high of 176.22 today.
Yeah.
Volume was 65% above average, so not bad.
Absolutely.
They're also previously they had a really nice strong uptrend before. So something's going on with this stock right now, and it's appealing to Wall Street. Their earnings and sales aren't necessarily great or impressive, right? But it is in the beverage industry, so you kind of have to keep that into context too. But when you look through the beverage industry, when you're looking for ideas right now, these guys were probably one of the better performing ones.
Well,
there, right?
and just kind of scanning through the list, the chart really jumped out at me.
Yeah.
It was the setup that really jumped out at me on this one. But that group has been moving up, and right now it's number 19 out of 197 industry groups. So again, beverages, alcoholic, just there's a lot of these names that just keep on coming up on my screens.
I don't know if that's a good thing for the overall market or not, if the beverages start moving up, because that can be a defensive industry. And also it could be a play that, hey, maybe things are going to get worse and people are going to be drinking a lot more.
Right, yeah. But, I mean, it kind of makes sense right now that there is a little bit more of a defensive kind of – you're seeing some of the more defensive plays do a little bit better right now. But, again, we'll see if this holds. Right now, this is, even disregarding what type of industry it is, the chart still looks pretty good.
It does.
It's a nice base, and, again, it's showing pretty good relative strength.
Our third stock is Constellation Brands, ticker symbol STZ. And now this is another large beverage company here. And they have more than 100 brands in their portfolio, and a few that you might recognize: Corona, Pacifico, and Robert Mondavi, the wine. So there's another company that's obviously well-positioned to benefit from the football season, and many people going to bars to watch the games.
And of course, keep in mind, football season happens at the same time every year, and with earnings, that seasonality is taken into account. So of course, I don't want people to think, oh, don't you know how earnings are done? Yeah, we know that it's going to be compared to the same football season, same way toy companies are. Christmas is compared to Christmas of the last year. But again, what we're really kind of pointing out here is the strength of the industry, as well as these are stocks that have pretty good sales. There was some negative or slowing growth for stars, the last quarter or two. So it's not phenomenal in that regard, but it's still one of those that's been holding up well. And on these types of stocks, you kind of have to understand, what is the industry group typically doing. So this is not one like tech where you see the earnings growth of 20% and more.
Right.
This tends to be a little bit more muted, like with a lot of your big box retail stores as well, where the margins are a little bit thinner, and they're trying to do it on volume.
Yeah, and they just emerged out of a cup with handle this week, And so something to keep an eye on. RS ratings an 84. It's going to be obviously a little bit slower mover, but as Justin mentioned, it's been starting to look a little bit more appealing versus a lot of the other stocks in the market.
And just one more that's we should mention because it's strong is Boston Beer Company. They're the maker of Samuel Adams, of course.
So ticker symbol SAM.
SAM, and this one it's not in position really. It broke out of a base. In fact, it got 20% from its last base, so that might be a place where you are taking profits. If you're getting 20% in this market, hey, be happy and take those profits. Or in this case, we do see it pulling back to the 50-day moving average line. I don't know that I'd be wanting to initiate, off a 50-day moving average line here on something that's been up so much. But it's, it's, again, one of the stronger looking stocks out there. And the relative strength of 95 and composite rating of 96.
And one more stock, WingStop, W-I-N-G. And now WingStop, out of all of them, these guys have consistently been coming through our screens, IBD 50, the Growth 250, for a couple of years now.
Yeah,
right.
Yeah. And this is a recent IPO. The IPO was back in 2015. So it kind of and again, this is one where it went down significantly, lost almost half of its value very quickly. But then it formed a nice base after base after base as it kind of built its kind of trading history.
Right.
And then really in 2017 is when this started really kind of coming alive and looking very strong, and it really hasn't stopped since.
So it's essentially it was like a player in the NFL who's been there for 2 to 3 years.
Right.
And now they're really starting to hit their stride because they got used to the speed and know how to play and all that kind of stuff.
Or maybe, hey, they just got to be the starter now.
That's true too.
Right.
That's true. And it has been really since it really got going back in late 2017. This stock has been a rocket ship. It's been a dramatic outperformer, and they're doing something that you see in a lot of industries. They're starting to build a brand name in one specific industry, in the chicken wing business, right? And they're consolidating it, right? Before you have all these chicken wing stores out there. Now you start thinking, I want chicken wings. Oh, WingStop, right? It's that brand recognition is there, and they're definitely benefiting from it, and Wall Street's rewarding the stock. Now, the stock is extended at this point.
Another one that's kind of pulling back to the 50-day moving average. Looks like it got some support there. Not much volume on the bounce today on Wednesday, but yeah, we'll see if it can maintain itself above the 50-day moving average. And this is one that has been doing that. These are the greatest stocks to have when they just maintain themselves above the 50-day moving average, because you can just kind of hold them and almost forget about them. This is your football player that just performs week after week after week, and just keeps on putting points up on the board, and you don't have to worry about injuries and stuff because they just keep on going.
And they'll carry your portfolio to a championship.
Exactly.
So there are a number of companies that benefit from football. So you definitely want to take a look at them and consider adding them to your watch list, and hopping on them when they actually give you the opportunity to do so. Thanks, Justin, for being here today.
Yeah, it was a lot of fun.
That's it for this week on Investing with IBD. Coming up next week, we will have Evan Harvey, the Global Head of Sustainability at NASDAQ. We're going to talk about the evolution of environmental, social, and governance reporting, and why you want to consider including the ESG ratings into your stock analysis. And so that's it. I'm Marusha Paris, and thanks for listening. And for this week's Nielsen charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.